Hello, good morning or good afternoon. Thank you very, very much for joining this webinar and for making the time to talk through the path to 2030 what is exactly does the journey between now and then look like in the middle and the back office. So my name is Barnaby Nelson. I'm CEO of the ValueExchange. It's a real pleasure to have everyone for this joint webinar between the ValueExchange and FIS to talk through, as I said, really fundamentally one question, which is really how and where are firms, particularly on the sell side, making the business case and the space to be able to drive change of up to about $280 million worth of transformation in platforms and process in the next 5 years. So, this is in the face of some very significant existential challenges that we're going to come on to. And it's really fantastic to be able to actually talk through this for the next 45 minutes to an hour with three very, very senior and experienced industry experts. So thank you to Brian from the DTCC for joining us today. Basically really representing all of your discussions and hopefully conveying all of your conversations with thousands of market participants, both in the US and obviously overseas every day. So Brian, thank you for joining in. Bhavesh, head of post-trade at DriveWealth. Really want to, major kind of technology-based wealth manager will come on to one of the hot spots of overall industry transformation is this space. So it's fantastic to have somebody who's actually driving the change with the hands on the machinery every day. So Bhavesh, thank you for joining us. And Mack, who runs securities processing at FIS Capital Markets, and very much the person who's making the change happen. Probably not individually or single-handedly, but essentially, really as the base layer to all of the change that we're talking about, how being able to actually relay conversations from across the world in terms of exactly how people are not only making the case for transformation, but also exactly how that's being realized. So this conversation is going to focus, as you can tell by by Bhavesh's picture, but also by the guests. We're going to focus. There's going to be a strongly North American tint to this. We were just saying beforehand, we'll probably talk about the hockey a little bit, but the most important thing will be to go through essentially what the view is from this side of the Atlantic. And tomorrow the conversation will be complemented by a second webinar where we'll have a European Asian perspective from Sam Riley at Clearstream, Bruno Component at BNP Paribas, Andy Murphy at UBS, and Mack drawing everything together to give us a consistent global perspective. So what we're going to do is, as we go through this conversation, this whole discussion draws on some very extensive research that the ValueExchange has been running with FIS for the last several months, looking at exactly how, where, and why people are making the case for change. So what I want to do is just to open up the conversation really with a kind of key point, and then I'm going to ask Mack for your views straight away as we go into this. Before I do, I should have mentioned at the beginning, this obviously is all about you guys as participants in this webinar. So we're ready to talk, and there's enough to talk about here for about 3 days. We'll try and condense it down to a short piece, but the most important thing is that this feeds into your own thinking, planning, and discussions. So if what we're saying triggers questions, please do send them through. If anything we're saying isn't clear or anything like that, please do use the Q&A function on the bottom of your screen to be able to raise and flag questions as we go. And we will make time through the conversation and at the end to make sure that that all of the points are answered and that you get as much out of this as you possibly can. So please do make the most of this, because frankly, this is all about you and us sharing our information to help you make that business case. So in terms of the business case for change, Mack, we've been talking a lot. If you go back to the SIFMA presentation, to the conversations we've had, the starting point of all of this, why we're even having this discussion, seems to be that all of the cliches are true. The shift to passive, has created an enormous cost challenge on the buy side that is triggering a cost saving of about $1.6 million per fund target per year. And ultimately, that's that from all the conversations we've had, that seems to be triggering a shift in terms of the existential mission statement for what a broker or a wealth manager is. Across what do they do every day in terms of competencies that they offer their clients? How do they interact with their clients? And ultimately, how much scale do they have? So three big variables, if you like. How does that reconcile with what you're seeing across the kind of EIB and broker space at the moment in terms of client pressures and shifts?
Yeah, thanks, Barney, and it's great to be here with the rest of the group here. Look, I'm seeing nothing but change right now. I think all of us here have been in the industry a fair amount of time, and it's just amazing to me that things continue to accelerate, both in terms of market structure, the technology, and just overall competitive dynamics. And some of the things you shared on the screen earlier about that buy side, sell side dynamic, the shift to passive, just the massive pressure on cost and competitiveness. That obviously continues to be kind of the macro. And then if you look at, and that's only going to get more intense, I think, if you go on year by year. So I think that's a common theme that we're all dealing with in terms of the underlying economics of our industry. But then obviously you also have all the change we've had lately with T+1, and and again that was perceived as, and it was a success. I mean, an objective success in terms of the outcome. I mean, if you look at the market volatility of the early part of this year, I mean, a lot of industry observers talk to the benefit of the new settlement cycle in terms of managing liquidity through the high volume periods. So that's great. I would argue that one of the goals of the regulators with T1 in North America, and we're seeing that same dynamic and dialogue now in the UK and Europe, is not just hitting T1, but it's about focusing on automation overall for the industry and all the benefits that come from that. And frankly, in North America, there wasn't all of that much automation that actually came through T+1. People tweaked their daily cycles. They often added more ops people, and in order to kind of get to that new T1 cycle. I think we heard a lot about micro batches for a lot of the industry that's still running on mainframes. And again, positive success. But if you look at automating allocations, confirms, settlement matching, recs, all of that, there wasn't as much to that. So now, I mean, to your question, now here we are in 2025, and I think we're dealing with three big factors. One is the ongoing increase in retail, and obviously Bhavesh at DriveWealth has seen a lot of involvement there. But we're seeing more and more retail investors around the world, and that includes into new asset classes like crypto. And that's driving a lot of change. I'd say related to that, we have, and I think we're all seeing a bit of a tipping point in terms of institutional interest with with the wider digital asset community, and I'm sure we can talk more about stable coins and tokenization. That's driving a lot of change. So that's kind of one macro point for this year. The next one is market structure. And we talked a lot about T+1, but 23/5, 24/5, 24/7, whatever flavor you want to look at, that's coming, and we're all going to have to deal with that. And frankly, that's going to be a much bigger operational and technical challenge than T+1. And again, I think that an industry that in many ways is running on mainframes is going to have a real challenge dealing with that massive shift across the securities markets. So that's of interest. And then the third area is just the ongoing development of infrastructure, the underlying technology that our industry is starting to take advantage of. Again, we're anchored very much as an industry in batch, but cloud continues to make great progress, and we're all on a AI journey one way or the other, and looking at how we facilitate that. And And I think, we need to be looking at the underlying infrastructure, and a common theme about modernizing our infrastructure. We are way behind as an industry, and we all know that. And we need to work together to figure out how we get that glide path into, to a more modern infrastructure capability. So these are some of the themes that, that we're seeing, dealing with our clients and the wider industry. And
Yeah.
And it kind of comes back to a lot of I think some of the data that you've done, with your recent research. I'm sure we'll unpick quite a bit of that.
Yeah. Yeah, no, look, thanks for that, because I mean, I think it's I think one of the challenges, and Brian, to come to you if I may, the challenge is that the list, and I'm sure it's just about to get longer in terms of all the different to-do items and things for facing a market participant today, is how do you take a long, wide list and actually prioritize it in some way? But from your angle, Brian, I mean, how do you see the challenges and when you speak to, as I said, literally thousands of participants every day, what do you see as the kind of the major themes that you've gone through, given T+1, 24/7, 24/5,
Sure.
plus plus plus?
Sure. And Barney, I'll start off by saying thank you. I think this is great. It's great to be here. And to answer your question, I think Mack did a really nice job, frankly, of covering the waterfront as it relates to the pressures that particular investment banks and broker dealers are facing today. Yes, I think it is. Markets are moving faster and more real time. I think that's factual. We obviously have just gone through the T+1 in the United States. It's happening in the UK and the EU over the course of the next 18 months. I think there was some question as to whether or not equity markets would move towards a 24/5, and I'll say factually they are, and frankly in some ways they already are there. Right, ATSs operate nearly at a 24/5 market today, and this is more about the exchanges and other ATSs, particularly in the U.S., moving to that same cycle. And the clearinghouse in the U.S., and that's NSCC that we operate for the industry, is following suit. So in Q2 of next year, we'll have a clearinghouse that operates on a 24/5 cycle, and then allowing us to take counterparty risk out of the system for those who choose to operate and trade in after hours that extend well beyond the 8 p.m. today. That's sort of normal convention for after hours. So I think that's sort of a major theme that Matt covered, which I completely agree with. I think the other piece is, we often hear from a lot of our clients the capital pressures and margin pressures. Those are continually avenues of focus from our clients, particularly broker-dealer clients. Bank capital, for those that are bank broker-dealers, that is a sort of particular avenue of focus in terms of how to find avenues of capital efficiency. We've stood up a program at the firm that really focuses on capital and liquidity optimization, through the multiple services that frankly we provide that cut across different asset classes, and making best use for our clients around the capital that they have in their various businesses that intersect with DTCC. And part of that is, how do we find margin optimization? It's well publicized that DTCC is working hand in glove with the CME, in particular in the treasury market, around cross-margining and expanding our cross-margining arrangement. But frankly, there are other cross-margining arrangements that we're exploring, with the OCC as a good example on listed options, and the cross-margining opportunity that exists with our equities business is pretty incredible, sort of realizing that level of efficiency for the industry. So I'd say sort of capital margin liquidity is still yet another theme. Matt talked about this as well, but innovation is a key point of focus from our broker-dealer clients, and that is, obviously through AI, it's well socialized in terms of the various degrees of maturity that exists in the industry around firms' AI strategy. But I think digital assets is equally a disruptive factor, and in particular in the U.S. market, and with the change of administration, much more supportive of the maturation of digital assets. That is, sort of no longer being kind of orchestrated by a sort of separate part of the firm and sort of a digital assets, sort of segment of the organization. It's sort of much more endemic across the organization around where digital assets is going to play a significant role in the future. And how that could change business models, how that could change the role of the intermediary. I think that the next 18 months or so is going to be pretty significant. And that goes hand in glove with the crypto market itself. I think about crypto as an asset class. When I think about digital assets or what I just talked about, that's more of sort of tokenization, blockchain, smart contracts as the technology that could change financial services. But crypto as an asset class, frankly, as well, seeing much more institutional growth, potentially moving into retirement plans and being much more part of what I'd call traditional finance. That is equally putting pressure on broker dealers to sort of be able to manage that asset class and service their clients in that particular way. And then the last thing I'd probably highlight is really the exponential growth in private markets. And in particular, private credit, private shares, private equity, those sort of segments of private markets, the growth that we have seen and the growth that we'll see over the course of the next 8 to 10 years that's projected is pretty incredible. Companies are staying private longer, if not in perpetuity. Public markets are volatile and still growing, but not growing nearly at the pace that they were 10 years ago. And so that capital markets formation is happening in the private markets. And for those that are obviously sort of intersect with those markets today, it's growth. For those that don't, looking to how they service those markets, in particular for those clients in the future. So I think those are the avenues for me that are really sort of the pressures on the broker-dealer community.
Yeah, no, look, thank you. And this is great. I've literally got the list of things we're going to come back to. But Bhavesh, from your perspective, we've got client pressures, T+1, 24/5, capital margin pressures, digital assets, and private markets. Before you even came into this call, what would you have said? How do you make sense of all of this in terms of what you would describe as your Monday morning first 10 minutes of what you need to be thinking about in a week?
Yeah, as you said, and Brian and Mack correctly pointed out that the stark imbalance between the buy side and the sell side investment demands, right? Like we are seeing a growing disparity in the transforming how the broker dealer mission is being transformed. So we don't think the firms are just measured on the execution quality or market access, but broker dealers are now really expected to deliver platform-based, always available, and this is going to where digital assets like 24/7 in digital assets or traditional assets, right? That will become a key requirement, believe it or not. And data-rich services which really align with real-time and digital client workflows. So where the trend we are seeing from Dry Wealth is, it's a mobile-first experience, right? Users are always on mobile, trading on mobile. They're instant notification, right? You get a corporate actions dividends. It's instantly available as a notification in a mobile, and that really needs that. Broker dealers need to be completely digitizing their infrastructure, right? To cater mobile and API first technology, right? Technology will become a lot more modular. We will see a lot more buy versus build, right? You will integrate with specialized vendors across the firm to provide digital assets, traditional assets, global markets, and build for that real-time visibility and responsiveness. Your integration layer will become a lot more normalized across your different systems or subsystems. And as you power through integration with other third-party providers, what we will see is data normalization will also become a key, right? Exposing your API layers through a single, normalized data integration layer will become key. So in that sense, Dry Wealth brokerage as a service is already emblemating of where the industry is heading. We are providing digital embedded market access and real-time clearing and platform extensibility, which supports both institutional and retail clients on a global scale.
Yeah. No, look, brilliant. Thank you. Because obviously it makes for a long list, but I think for me, what's so fascinating if you draw all of this together is that everything we're talking about, all of these changes, everything needs to end up on an app on your phone that's working seamlessly 24/7. It's fantastic that we're doing all of these big things and we're trying to drive pressures and automate and all this kind of stuff. But the ultimate outcome that we're now aiming for is very different from can you keep a back office running with a bunch of people running around with faxes and pieces of paper 10 hours a day. Now we're talking about not just an increase in inputs of what's straining the operating model, but also an increase in outputs in terms of what's got, what the availability has got to be. So, I mean, thank you guys all for stringing that together. I mean, maybe, the question obviously is, how do we respond to all of this? And actually, what does this look like when we look at the operating model? And to your point, we've talked about kind of where you're kind of going on the kind of the data normalization, the platform based kind of modularization, all these things. To come back to you, Mack, I mean, one of the things that we've seen in the research is, there are firms who are leaning into this, who are spending, $280 million on transformation every year on average at the top tier, going down to, obviously different degrees of multiples of that, depending on who you are. But, how does this all come together, if you like? Because what does the operating model look like that can span all of the different pieces? And, when people come to you and say, right, okay, we need you to run our infrastructure for the next 10 years. What are they really asking for here in terms of actually the target operating model that they're building around this?
Well, I mean, I think back to the point you made in your question, I mean, what we are seeing is that pivot of investment. So before, it was more of, the whole term of, run the bank from a post-trade perspective. For many, many years, a lot of people ran the bank. But again, given all the changes we've been talking about over the last number of years, they're really coming to a head now. And, every year, I would have said the same thing last year, but it goes even further this year. And I'm sure next year we'll feel it even more. But given all these changes, people are realizing they need to pivot investment into being able to handle all this change. And that really is a post-trade capability change. It's funny, Brian mentioned the change to, with digital assets. In some ways, with crypto and digital assets, it actually changed the way the industry, and certainly the front office or the top of the house, viewed post-trade and ops. Because in a way, it's a profit center, if you will. Maybe even directly from a digital asset perspective, but certainly indirectly, in order to get into this market structure change or get into new asset classes, you have to be able to support that from a post-trade perspective. If you can't do that, you're not driving top line growth. So I think there's been a real change of perspective. That's why we're seeing this, this change in investment. And then back to the other part of your question, I think Bhavesh really nailed it, is that we're moving away from this monolithic mainframe based market structure in post-trade in North America, and where frankly we've had a limited number of providers and all running highly efficient operations. I mean, let's not forget there are benefits to these types of systems. That's why they've lasted for many, many decades. However, they are black boxes and they're monolithic. And now we need to be, as an industry, we need to be able to change, we need to adapt. And I think this, to use the words that Bhavesh used, this modular API-driven approach is what the industry really wants. They want to be able to add new elements of value. They want to get into a new asset class. They want to be able to not just have that front office change, but they need to map it all the way through, the full post-trade cycle. And so that flexibility is something that the industry, from a technology perspective, is now able to provide. Like we as technology providers are able to do that and able to flex more. And there's a lot of new technology coming into the industry to do that. So I think that is a whole change in terms of how, we have market structure change, but it's also a change in how the technology industry, the vendor community is being able to support that for broker dealers and banks.
Yeah. So it's not just basically playing for just a single, just a massive great, just take over the back office with one box and hope that everything works. It's much more of a nuanced discussion, if I hear you right, around exactly pieces, the best piece for each piece of the activity in a much more kind of fractional way.
Well, absolutely, because our role should be helping each of our clients get competitive advantage.
Yep.
It's not a black box, it's about competitive advantage. It's about being able to act fast and add value. That's what the vendor community needs to do. And I think that's a big change.
Yeah. And if I may, Brian, from your angle, obviously the elephant in the room here is the legacy platform that, people have been running on for, I always joke that there's one market infrastructure, not in your neck of the woods, that's celebrating its 50th anniversary for its core processing kit. Mm-hmm. But it's that's just on one side. But the banks that you're speaking to every day and the brokers that you're speaking to every day, there's so much change going on here. And, you're obviously a change partner for all of those, but how do you find that whole conversation around, yeah, but hang on, I'm still struggling to just basically just to get rid of the facts from last year, how do and how do we manage that whole legacy thing when the legacy challenge is just such a pullback in terms of our ability to react to things? Just curious, both from your experience now and also obviously from your prior life.
Yeah, I think it's a good question. I mean, I think there's a couple dimensions to how to answer that question. There's many firms, and DTCC is certainly one of them, are dealing with legacy technology, right? And I think Mack had put it well. It's sort of mainframe-based technology that runs incredibly efficiently and is actually incredibly resilient. As we think about, always being up for markets, but it's end of life, and making the tough choice of investing in potentially revenue accretive opportunities or new business ventures versus that of replacing the kit that exists, that services the existing set of businesses, kind of the run the bank businesses, is always sort of the constant struggle and decision making that firms have to make. We ourselves are on a multi-year journey to invest in completely modernizing our core clearing and settlement platform that exists at the firm, moving off of a mainframe infrastructure, moving to a much more distributed architecture. And in doing so, what we're finding is, sort of unbundling the services that exist in the mainframe and the years and years of, sort of interaction points and services that we've stood up for our clients, that there's a lot of bespoke processing that exists embedded in those systems. And so, we're as much thinking about, as we modernize and make this pretty significant investment, what products and services do we offer to our clients in the future, right? As we think about, the facets of how we started this whole conversation, how the market is changing, as much as how do we institute standards for the market that will provide real levels of scale and cost efficiency for our clients. Now, not lost on anybody is the fact that our clients also need to change, right? If in fact there was a system that we were reviewing that had effectively 42 different message types that allowed clients to come into and interact with DTCC, we're bringing that down to 2. So for anyone that was using the other 40, those are all changes that clients will now need to make as a function of interacting with DTCC. But all good investment. But of course, that comes at tough decision making and prioritization for other things that clients want to do.
Yeah.
So, I think, what we're hearing from our clients is they want to know early and often where those changes are happening so they can couple them with their own infrastructure and architecture decisions that they're making at their firm. Clients are moving to a much more platform-based architecture, much more microservices, not where for years and years we've operated effectively in asset class silos, that service particular parts of the ecosystem very much in a vertical, and now through much more of a platform or horizontal based approach, those life cycle sort of processes that exist that service multiple asset classes, the systems are being invested in that of course can cut across multiple parts of our ecosystem. So the sort of the investment's happening, and I think it's both driven by some market structure, as Max said before. I think also driven by sort of end of life investments that are much needed to be made.
No, look, and thanks for that, because I think for me, what really, obviously, as you say, you are not only a massive enabler of communication in terms of market participants, but you're also a massive consumer of kit, as you said, from your own infrastructure. And I think that the whole theme of that peeling back of bespoke processing, and working together between the FMI and the participant, as you said, to peel back 40 down to 2, that can only reduce friction, reduce cost, reduce risk for both sides, and therefore obviously drive some pretty substantial market improvements. And I think for me, we always I think we skip past that and look at the big box, but actually the efficiency of the communication between, two sides of the kind of counterparties is a fundamental pillar in all of this. And I mean, Bhavesh, I suppose similar question for you. I mean, to think about what you were just running through, platform-based infrastructure, modularization, data normalization. How do you do that when presumably you're carrying a whole bunch of legacy kit as well? I mean, one of the things that we've seen is that, from a wealth space, the competition and the platform spend in your space is probably outstrips anywhere else in the world. How do you see the two, kind of where you come from versus where you're going?
Yeah, I mean, I think, and I've seen a significant shift in my career journey already, right? Coming from banks like Merrill Lynch and Bank of America, where we used to have mainframe, and we still have mainframe-based clearing and settlement systems to drive wealth, which fortunately for me right now was completely built on cloud and API based. So it's definitely, we don't have the same legacy infrastructure as others have, and that's an advantage. But I don't think we can take that advantage for granted, because industry is changing so much, right? And while we can, and I can say that we were built on cloud and API first, we already seeing a significant need for transformation and being ready for the next 5 to 10 years, right? And that is because scale is a given, right? So cloud, where it was a differentiated when travel started, it's no longer a differentiator, right? So we need to continue to invest in technology. We need to continue to upgrade our platform. As I said, right, like being able to provide products a lot faster requires that your platform and people, right, are very agile, right? You are able to turn around like digital assets 24/5 very quickly, right? And that's really the motivation for you to have a platform which not only scales, but really adopts and builds very, very fast, right?
Yeah.
And I think we should definitely look at the people angle to it as well, right? As the pressure on big banks and mainframe is also the scarcity of the talent, where you don't have people who can code mainframe anymore, right? So that, and where we are seeing the differentiation or normalization is technology, even with operations and our partners, right? Everyone is becoming tech savvy, right? So API, when it would have been probably a very technology or technical terms 10 years back, it's no longer just a technology thing, right? Our products, our ops, like they're very well versed with API. And I think that's the transformation we are seeing, that it's going to be an even playing field, and it's no longer just a differentiator in few years.
Yeah, no, it's a great point. I mean, I think, and I'm glad you raised the talent point, because ultimately, it's such a, again, it's a little bit like we were saying about the frictions in the trade. It's such a key enabler in terms of, or a key reason for change that we probably don't fess up to enough, I think, in terms of actually the reasons why this stuff is why so much of the transformation is urgent. But I think also, I think it's such a fascinating angle as well, that today's new system is tomorrow's legacy platform, and actually starting to see ahead for that. Just because you're not in the red light end of life legacy zone right now doesn't mean that if you sit on your hands for the next 10 years or 5 years, you're quickly going to get into that zone. So how do you build that scalability? And it's a really core piece. So just to drill down, I mean, there's obviously a lot in the shopping list that we've talked about, but I want to just walk through three areas, if I may. T+1, collateral and treasury efficiency, and digital assets as three big areas that we've touched on. And I'm just curious to see, kind of from your respective views, what are people actually doing in each of those spaces in terms of actually the kind of change that they're driving in each of those. So I mean, Mack, from your angle, I mean, T+1, obviously, we've talked in the past, it spans everything from client onboarding all the way through to asset servicing. How are you finding people coming to you now and saying, actually, do you know what? We're first of all, we need to change because of T+1. Are they, or are they not? And also, kind of, where do you find the pressure points coming?
Well, I think, folks that we're talking to now really are looking ahead. I mean, T1 obviously is embedded. I think people that are, especially smaller firms that are coming into the business or growing into certain asset or into the securities industry, are looking at really being ready for T0. And actually, it's a lot of the conversation over in the UK and Europe right now, where they do have a bit of time to get to, the end of 2027 when T1 hits. A lot of people are saying, well, we shouldn't be preparing for T1. We should really be ready for a T0 environment, intraday, and then making sure that obviously that all the allocations, everything that's happening even before as much as possible, and that comes back to the point we've raised in different contexts in the last half an hour, is all about real time. You're really trying to run a real time environment, because again, if you're trying to operate cross asset, and especially getting into digital assets, you really have to be prepared from a tech and an ops perspective to be dealing with things, intraday, and therefore very automated, obviously. And so I think that's people are thinking about settlement cycles and T1. It's really, the action and the interest really is into intraday, T0, what can we get done on that basis? And so it's a automation conversation. So it's not just, what system are you using? It really is a very much an ops and tech combined environment, and how you can focus on automation. That to me is a common theme, and it hits a lot of different points together. Settlement cycle, goals, whether or not it's T1 or down the road T0. And I'll say netted T0 just to contextualize that.
Yep.
But or whether or not you have somebody who's also trying to, in a multi or a cross asset environment, trying to support a crypto business or what have you. It really is the same common theme, and I think that's interesting. Where again, Brian mentioned this earlier, we come from such a siloed industry, and that's the business, the ops, and the tech, and the vendor systems through all this change, people looking at it in a much more holistic cross-asset perspective. So that's definitely a common theme.
Yeah, and presumably only just about to get more important. I mean, as we move across the Atlantic with T+1, the whole idea that actually it moves out of normal operating hours and it becomes a cash funding thing with FX exposures. This is only going to get more real, and as you said, those real-time pressures are only going to get bigger as participants here in the kind of generally in the North American zone start looking at T1 offshore as opposed to just onshore. Yeah. I mean, Brian, from your angle, I was actually going to come and I'll follow you up on the collateral point, but from a T1 angle, I mean, just out of interest, how are you seeing kind of firms starting to prepare for as Max says, what lies ahead in terms of T1 over the other side of the Atlantic? I mean, are you seeing a change in projects, or are you seeing a continuation, if you like?
Yeah, I am. What we're hearing from clients is a similar kind of preparation methodology that they undertook for the change in T+1 in the United States. I think there was, Mac had highlighted this before, but we sort of look back 3 or 4 years ago and sort of started this journey of moving to T+1 in the United States. It was a lot of, resources are going to have to change, and we're going to have to increase the number of people, and we're going to have to figure out the sort of global support model for anyone who doesn't otherwise operate sort of a follow the sun kind of global business model. And I think through that transition of the sort of last kind of 2 or 3 years, firms started to make concerted, sort of automation investments, right? Investments in their infrastructure, as much as, yes, sort out the org model and make sure that the right kind of operational models in place. But fundamentally, it went from, 18 hours to 4 hours of processing time. You can't just sort of do that with people. Yeah. Right, that needs to be addressed really through technology means to be able to handle that increase. And I think Mac made a good point in terms of the market moving to T+0. I think there's definitely some conversation. I think there's a lot of hair on the what happens with all the trade life cycle processes that exist, even pre-trade, but certainly those post-execution through to settlement in an environment which is more operating on either real-time or netted T+0 cycle. But in particular in the UK and EU, we're hearing from clients is anyone who sort of hasn't made those automation investments yet certainly are considering to do so. I think clients who don't otherwise use automation through vendors or through technology platforms around things like allocation and confirmation, I think are looking to do so. The concept of place of settlement, so data that persists as part of the normal life cycle of activity, like place of settlement, I think is another component that I think will enrich the automation that doesn't always exist, and that creates today, in the absence of some of those reference data points, the friction points that exist that contribute to fails or otherwise funding costs for clients. And I think investments in similar around settlements, the settlement instructions and other points of reference data that just enrich the transaction activity and the trade activity to get to a point of a faster settlement cycle. And so, any of those natural friction points, which I think in many ways surfaced as part of the investments that happen in the U.S., they're going to exist in Europe as well. It's just because there's much more there's more infrastructure providers, there's more middleware providers, there's more clearinghouses, there's sort of more choice in so many different ways, right? That in and of itself creates more friction points, and I think cause the need for some of the investments that I talked about earlier.
No, 100%. No, look, and thanks, because I think stringing that together, you've got, as you said, as a core foundation, Mac, you've got this real, T1 means basically you have to be running something closely resembling 24 hours a day, just given the hours of operation. I think one of the research things that we did last year was 86% of processing is going to be overnight when we move across to T+1 when you're 8 hours away. So, it is fundamentally an overnight activity now. And so, as you said, Brian, the only thing you can do, you just cannot get away from automating your allocations, your confirmations, get that trade right, and your SSI set up. And I mean, realistically, if you're not doing that, then basically everything downstream is just going to trigger quantities of phone calls and emails that are just going to go off the charts. I mean, does that resonate, Bhavesh, from your angle? I mean, obviously you're kind of seeing this, and you're the guy, as you were saying, it's all got to end up on the app on somebody's phone.
Yeah, I mean, I think I cannot, I'll probably say real time on this conference and otherwise, maybe many times, but that's reality. And I think that's one of the most important ingredient as we look forward, right? To 24/5, 24/7, crypto assets are leading the way. And I think, real time, but real time has to be broken down a lot further, right? When people think real time, okay, I got trade in real time from front office and goes into back office, but it has to be a lot more than that, right? You have to have real time observability across your platforms, across your operational flows. You should be able to react. A lot of the legacy T+1 reconciliations and all of that stuff, right, also have to be brought in real time, right? We need to have your risk managed in real time, right? Not just reactively on the settlement day or past years, right? I think a lot of this real time needs to be double click, look in the hood, and the whole journey, the whole processes across the board, not just front office, but back office, operations, data, everything has to become real time. And that also, is one of the core foundation on which AI experience and AI will be built, right? If you need access to automation and build AI and ML tools, right? One of the key differentiator would be how real time you can access your data, how clean is your data, right? So this is not just operational resiliency, but also what you're going to build the AI and the ML platform in future. So yes, I mean, I cannot emphasize it enough.
That's a great point. We haven't even overlaid AI onto everything we talked about, but ultimately, if you're building on weak foundations, if I hear you right, then ultimately you're not going to get anywhere with any of the new technologies that sit on top of it. Yeah. So following on from that, so the question of real-time risk management, and Brian, coming back on this whole idea you were saying about kind of treasury efficiency and the growing role of capital, basically, for me, there's two sides of this, and I was curious to see kind of how you see this playing out in real steps, because you said you've got cross margining, so consolidating everything into a single margin call, but then you've also got, as Bhavesh says, a move towards real time risk management, and I was kind of curious to see how you feel that things are moving in that direction in terms of what you're being asked for from the industry, as we move from, as you said, I mean, in any given market, more fractionalized margin calls, generally on a more overnight basis than a total real-time basis. Are you being pulled massively in this space?
Yeah, and I think it underscores what I talked a little bit about earlier, which is the continued focus from our clients on capital efficiency, right, and margin efficiency. It's and this dovetails really into the natural use case we hear from all of our clients in terms of where we should be focused first in digital assets is around collateral optimization. Right. Collateral that's otherwise trapped in various parts of the world or in infrastructures based on operating hours, based on the sort of rules or jurisdictions of that environment where the collateral is operating today, tokenizing those assets and allowing them to be used for in the most optimal way possible for different purposes that exist where collateral is used today, which is sort of the lifeblood of the industry, as we can all probably attest to.
Yeah.
That naturally is sort of a first use case for this type of technology, but it calls to really kind of those capital and liquidity pressures I talked about before.
Yeah.
It won't just simply be through tokenization. It'll be through the collaboration across those that have various clearinghouses as an example for cross margining arrangements. I think is another good opportunity. I think firms like ourselves are looking across different services that they provide for clients. How do we make best use of even capital that's trapped within the infrastructure itself, and provide clients with cost efficiency through making use of capital that's already at our disposal within our firm. And this all sort of with a bit of a backdrop towards changes that are happening, obviously in the repo market and the financing market in general, right, which is a move towards, at least in the United States, in the treasury market, towards central clearing over the course of the next 18 months. And our firm is a big part of the change that's moving in that direction. We've seen record volumes increase in putting activity into clearing over the course of the last 2 years since the SEC's Treasury clearing rule went draft. Our volumes have more than doubled since that took place. And so for me, that's a demonstration as much about some parts clients getting ready for the rule, but if in fact clients don't see commercial value in putting activity into clearing, they'll ultimately wait until they're sort of forced to do so as part of the mandate. So for me, that's a bit of a reinforcing mechanism that says there's real commercial value in moving activity into clearing. And that demonstrated itself in the April volatility we saw earlier this year, not only in the treasury market, but in the equities market. We had record volumes of activity in clearing, 5.5 trillion in the equities market, and we had record volumes in the treasury market in clearing, so 11.4 trillion. Never before have we had volumes of that at that level. And then, to tie back to T+1, in particular in the equities market, the amount of margin we are asking for from clients was fundamentally less than it was in peaks in the T+2 market. Taking that full day of settlement activity out of the clearinghouse had a real significant impact to the amount of margin we'll collect from clients and the amount of really what it is, intraday liquidity risk, and then ultimately systemic risk as a function of that, that is taken out of the system. And so, I think for me that's a top priority at the firm, which is to continue to press the envelope on where we can find capital efficiencies for our clients.
Yeah, no, absolutely. And look, I think for me, if you go back to the original statement, how do we make sure that we kind of facilitate this kind of generational cost restructuring going on across the buy and the sell side? At the end of the day, there is an ops line to it, but as you said, the capital line to it runs absolutely. They're symbiotic. Mandatory clearing is a perfect example of that. But ultimately, both they're two line items on the list, aren't they, in terms of actually how we can drive this stuff. And when you mix T1 together with some volatility, as you said earlier in the year, and suddenly, boom, you realize that actually the industry is significantly more cost efficient than it used to be. Yeah, absolutely. No, look, and so I guess. I was going to ask about digital assets, but we've kind of touched on collateral, and also my favorite topic has come up on a question which I want to raise to, I'm not sure actually to who, but so 24/5 and corporate actions. How do the two mix together? I mean, this has been it's been a fascinating kind of theme that I think has come out of a lot of the conversations following on from the announcements around 24/5, and the whole question about the way I read this question is ultimately, what does a day look like? In a 24/5, how do we manage, what is the end of day, et cetera, et cetera. I mean, I was curious. I mean, I don't know if anyone has a strong view. Brian, you're nodding, so I'll go for you first, and then maybe.
Yeah, I mean, I'll certainly take a stab at it. I mean, I think 24 by 5, there's one of the open questions we've heard from clients and more generally the industry as it pertains to 24 by 5 is how to handle corporate actions. And that really stems from my standpoint, and I'll credit SIFMA has done a lot of work to kind of galvanize the industry towards some of these open questions and start to address them. And corporate actions is one of those. Is what is the standard view of a U.S. trading day, right? Yeah. If different exchanges or ATSs are operating on different operating hours and they have different views of what a U.S. Standard view of the trading hours are for that particular market, well, that's where we have this fragmentation as to how to handle corporate action events, right? And I think there was some realization that aligning to a single view of the trading day, I think was the right direction of travel. And so, SIFMA published a paper on this recently, but I think ultimately landing on, the end of the day being 8 p.m. in the United States. And that is sort of the end of the trading day for that session. And then likely the primary exchanges will pick back up at 9 p.m., but the ATSs will continue to run on the 24 by 5 cycle. And so, if in fact corporate actions are you then now are able to process corporate actions knowing that, if you're operating through that sort of 8 to 8 period, that, you're subject to that dividend or subject to that, whatever that corporate action event is associated with the security.
Yeah. But I think it's fascinating. I mean, I remember the first time somebody raised that question, you think, oh, okay, you got something very sparkly like 24/5, and the single first question that comes up is the least sparkly thing on earth, which is a corporate action entitlement. And it's the oldest thing. I'm sure there are many corporate actions people feeling very gratified that their part of the world is suddenly the key dependency for all the sparkly change. So thank you for the questions that have come through during the various the discussion. So just to round up in terms of Mack, coming to you, one of the things that we talk about, you've got this vast number of list of things. We've talked about T+1, we've talked about market structure and 24/5, capital efficiency. We've touched on digital assets. We actually haven't come on to private markets, but which we'll do in another call one day. But, all of that basically seemingly triggering, coming back to the research, literally hundreds of millions of dollars of investment in this space by firms. So, as I said earlier on, $280 million of investment, depending on who you are. And then, as we were saying, Bhavesh, up to probably $7 or $8 million of capital investment in terms of per firm this year. I was just curious, really, as we round off, Mack and Bhavesh, how are you seeing people make the case for this? We've talked about all the various ingredients of the cake, but ultimately, how are you seeing people come together and actually say, do you know what? I can go and get approval for this much spend because of X, Y, and Z. Because that's ultimately, for me, the key thing is what's the outcome that we're trying to get to here?
Yeah, I think I mentioned it briefly before, but I think that what's different now compared to, let's call it an earlier cycle, certainly going back, let's say 5 years plus, is that investments and budget cycles and post-trade used to be really on a cost side of things, and people trying to squeeze a little cost here, squeeze a little cost there. And now, I mean, obviously cost is still very much there. I mean, that's a big driver as shown by the research, but it's tied to revenue growth as well, and the ability to get into new, to be more competitive and to flex. And so I see much more, let's call it kind of holistic business cases being made for the kind of investment change that you've tracked in your research. And the numbers are big because, again, we've talked about all this change and the industry is changing very quickly. And so I think we're seeing, bigger budgets for that and realization that we are at end of life for a lot of technology industry. We've talked about that. The other point too is very interesting. A lot of themes we've talked about in the last 45 minutes touch upon real time. And the need to be in the business to be able to have real time. And again, a lot of this industry is still run on batch processing. And so I think that simple fact will continue to drive a lot of that, that business case year by year. And so I think that's not going away anytime soon. We have years of that kind of investment ahead. But again, it is driving top line.
Yeah. So it's fascinating because I think for me, if you tie this together with everything we've been saying, the other stat that really stood out for me in the research was that firms are actually seeing kind of 10% ROI on this each year. So, this is something that this is not making promises for another generation to go and fulfill. This is actually something that is generating real returns now, but presumably only really because you are actually, as you said, taking that P&L view as opposed to just a cost center view, and actually looking at what Brian was saying around capital efficiency, around talent resilience, everything that we've touched on, and just making sure that all comes through. So for me, that immediacy of it also really stands out. And Bhavesh, I mean, from your angle, I don't know. First of all, we've touched on. I love this idea that basically it always ends up on your mobile phone. I mean, how do you find when you're kind of going and asking for the investment requests, to keep on this journey? I mean, how do you find that what presses the buttons internally, and how are you making that kind of case for the sustained investments that you've been making?
Yeah, I mean, I think it's pretty much what we have covered, right? That, as I said, brokers will be technology platforms, right? Technology will be the differentiator, right?
Mm-hmm.
You need to raise your bar, right? So that's the case you need to make. I think you also need to identify what is that your firm needs to differentiate, right? For example, if DriveWealth is really differentiating itself in managing the user experience and investing in brokerage experience, then we can make a case that some of the the other areas, like maybe it's the back office, right? We partner with a firm like FIS, right, which really does it for living, which really transforming in that own space. So we focus our energy on the user experience, what we do best, and then we integrate with the right technology provider to manage, right, some of the areas which is not a differentiator, right? And that's the case for investment, because that really then is minimizing your opportunity cost, right? So that's one. The second thing is, and this is how you lead the transformation as well, because you cannot solve everything on your own, right? You partner with the leading, right? Like we're changing partner with the disruptors who are changing the industry, and you then get the benefit of that technology, and getting on the technology curve. But ultimate theme is, like, unlike any other transformation, right? The AI transformation will be significant, and I know I keep coming on the AI, but there's so much foundational, right, to get this thing right, to get onto that bandwagon, right? We talked about real time. We talked about having clean data, right? Being able to adopt quickly. All these lead into how you harness the power of AI, right? Because that transformation, who gets onto that bandwagon, who is successful with that, will be like the gap between the haves and the have-nots will be significantly larger than the prior technology disruptions. And that's why you need to make investment to get ready, right? Because this industry, and pretty much most of it, will change drastically in the next 3 to 5 years. And if you're not making investment today, then you definitely will get disrupted.
Yeah. No, look, that's such a succinct, brilliant, and thank you so much for that. I think any firm basically who's not asking how they differentiate themselves, and frankly, are they ready for everything that lies ahead? I think that future-looking view, I think in the industry, it's very easy for us to get stuck in the present tense and a little bit of the past tense in terms of all the stuff that's going on. But ultimately, as you said, constantly keeping that forward-looking view of where are we differentiating, what technology lies ahead, and as you were saying earlier on, kind of basically what's now is what's good today is legacy tomorrow. I just think it's a brilliant way to round off. So thank you so much. I mean, we've covered a lot of ground, and I'm conscious that we're now up on time, but for me, if I summarize everything that we've talked about, there are a lot of seemingly disparate items on the to-do list. I think we've talked about basically a huge range of them. And for me, the key thing is ultimately is that they all have some very, very common answers. Many questions, common answers. We've talked about real time. We've talked about modularization, but ultimately we've talked about how does that operate in an operational context and a capital treasury context. And I think for me, rounding off with Bhavesh, your final point about how does this all drive our competitive advantage in each firm? These are seemingly kind of abstract, but I personally feel that they first of all resonate really strongly with the research that we've been doing, but also, they are the way that people are actually getting to spend hundreds of millions of dollars. So I really do appreciate you three walking through the thoughts that you have. I've got about 15 pages of notes here, so thank you. Just to round off for everyone that's listening, first of all, thank you very much for joining in. We are obviously, I'm sure there's many people that are going to be wanting to reach out to Brian, Bhavesh, and Mack to kind of carry on the conversation. So please do make sure you do that. If you'd like to read the research and actually dig into it further, the QR code is on the top right-hand side of the screen. And also, obviously, just reach out if you want a copy of it. We're more happy to share. But as I said, really, Mack, Bhavesh, Brian, thank you very, very much for a really fascinating conversation. I hope for all the audience that it's really helped to, give them the notes that they need for the next bit of change.